Hi, Assalamualaikum. My name is Nur Emilia Dana binti Nosham. My matric number is 272294. Today I want to talk about adjusting entries. Adjusting entries are made to update the accounts and bring them to their correct balance. The preparation of adjusting entries is an application of the accrual concept of accounting and the matching principle. The accrual concept states that income is recognized when earned regardless of when collected, and expense is recognized when incurred regardless of when paid. Purpose of adjusting entries is to update the account to conform with the accrual concept. At the end of the accounting period, some income and expenses may have not been recorded, taken up, or updated. Hence, there is need to update the accounts. If adjusting are not be prepared, some income, expense, asset, and liability account may not reflect their true value when reported in the financial statement. There are four types of adjusting entries: accurate income, accurate expense, deferred income, prepaid expense, depreciation, doubtful account, or bad debts. The composition of adjusting entry. A nominal account is account whose balance is measured from period to period. Nominal account include all account in the income statement, plus only withdrawal. There are also called temporary account or income statement account. Example of nominal account is service revenue, salaries expense, rent expense, utilities expense, drawing, and etc. All adjusting entries include at least a nominal account and a real account. Real account include cash, account receivable, rent receivable, account payable, capital, and others. Next, I want to talk about the financial statement. Financial statement is very important because financial statement should be relevant for the purpose for which they are prepared. Unnecessary, unconfusing disclosure should be avoided, and all of those that are relevant and material should be reported to the public. They should convey full and accurate information about the performance, position, progress, and prospect of an enterprise. They should be easily comparable with previous statements or with those of similar concern of industry. They should be prepared in classified form so that a better and meaningful analysis could be made. The financial statement should be prepared and presented at the right time. Undue delay in their preparation will reduce the significance and utility of the statement. The financial statement must have general acceptability and understanding. This can be achieved only by applying certain generally accepted accounting principles in their preparation. Financial statement is very important to management. The increase in size of complexities of factors affecting the business operation necessitate a scientific analytic approach in the management of modern business enterprise. Next, financial statement is very important to shareholders because management is separate from ownership in the case of company. Shareholders cannot directly take part in the day-to-day activities of business. However, the result of this activity should be reported to shareholders at the annual general body meeting in the form of financial statement. Next, financial statement is very important to lenders and creditors. The financial statement serves as a useful guide for the present and future supplier and probable lenders of the company. Next, financial statement important to the labor because workers are entitled to bonus depending upon the size of profit as disclosed by audited profit and the loss account. Next, important to the public. Business is a social entity. Various groups of society directly not connected with business are interested in knowing the position, progress, and prospect of a business enterprise. Next, financial statement is very important to the national economy because the rise and growth of corporate sector to a great extent influence the economic progress of a country.
Assalamualaikum and good morning. My name is Siti Nur Syamimi binti Zakaria, number matric 272102. Today I will discuss about the statement of profit or loss. The statement of profit or loss reports the revenue and expenses for a period of time based off the matching concept. The matching concept is applied by matching the expenses incurred during a period with the revenue that those expenses generated. The excess of the revenue over the expenses is called net income, net profit, or earnings. If expenses exceed revenue, the excess is a net loss. Statement of profit or loss are important because many companies are required by law or association membership to complete them. The statement of profit or loss also helps a company management team, including its board of directors, to understand the business net income, which may be helpful in decision-making process of the board of directors. For example, a business owner may consider whether his or her company is bringing in enough of a profit to justify renovating their building or expanding in other ways. You will also need to furnish a profit and loss if you are applying for a small business loan or if you are seeking funding from investors. Lenders and investors will evaluate your net income and operating income against the expenses, debts, and taxes to ensure your business is viable and worth providing financial assistance to. I will discuss about the statement of owner equity. The statement of an owner equity reports the changes in the owner equity for a period of time. It is prepared after the statement of profit or loss because the net income or net loss for the period must be reported in this statement. The importance of the statement of the owner equity is to help users of financial statement to identify the factors that cause a change in the owner equity over the accounting period. While the statement of changes in equity discloses significant information about equity that is not presented separately as well in the financial statement, and it is useful to external users in understanding the nature of the changes in the equity accounts. This owner equity begins when the capital is invested in the business by the owners and therefore increase or decrease as profits or losses are made in the business.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Nusha Sonimiti Shafi'i and my metric number 272164. Alright, I will continue the next statement, which is statement of financial position. What is the statement of financial position actually? Okay, the statement of financial position is another name for the balance sheet. It is one of the main financial statements. The statement of financial position reports an entity assets, liabilities, and the difference in their totals as the final moment of an accounting period. The structure of the statement of financial position is similar to the basic accounting equation. For a corporation, the format will be asset equal to liability plus stockholders' equity. A net profit organization format will be asset equal to liability plus net assets. So, why statement of financial position is important? Statement of financial position help users of financial statements to assess the financial health and entity. When analyzed over several accounting periods, balance sheets may assist in identifying underlying trends in the financial position of the entity. It is particularly helpful in determining the state of entity liquidity risk, financial risk, credit risk, and business risk. when used in conjunction with other financial statement of entity and the financial statement of its competitors. Balance sheet may help to identify relationships and trends which are indicative of potential problems or area for further improvement. Analysis of the statement of financial position could therefore assist the users of financial statement to predict the amount, timing, and volatility of entity future earnings. Since in the written assignment need to include statement of cash flow, so I will explain what is the definition statement of cash flow. Right, a cash flow statement is a financial statement that provides aggregate data regarding all cash inflows a company receives from its ongoing operation and external investment sources. It also includes all cash outflows that pay for business activity and investment during a given period. The company financial statement offers investor an analysis of budget of all transactions that go through the business, where every transaction contributes to its success. The cash flow statement is believed to be the most intuitive of all the financial statements because it follows the cash made by business in three main ways, which is through operation, investment, and financing. The sum of these three segments is called net cash flow. Why statement of cash flow is important? The statement of cash flow is very important to investor because it shows how much actual cash income a company has generated. The income statement, on the other hand, often includes non-cash revenue or expenses which the statement of cash flows excluded. So that's all from me. Thank you.